Assalamualaikum and good morning to our lecturer, Sir Mustafa Kamal and fellow audience. Today we are going to present about Maxis Berhad ratio analysis. First of all, let me introduce to my group member, Mr. Muhammad Raqi bin Shaharuddin, Mr. Jamili Adha bin Muhammad Jamil, Miss Sharifah Murfiqah Binti Syed Murad, and me myself Nasrul Bin Manap. Let's begin with what is financial statement analysis. It is a process of examining and analyzing a company accounting reports, it is financial statement, to evaluate its past, current and predicted future performance. So Maxis Berhad was founded in 1993 by Ananda Krishnan, established in 1995. Maxis was listed in market of Bursa Malaysia. It operates as an integrated communication service provider in Malaysia. It is the leading converged solution company in Malaysia. Also, the company, through mobile and fiber telecommunication technology, along with IT infrastructure services, offer mobile and fixed data product, voice, SMS, mobile payment, remote health monitoring, cloud solution, and business directory to businesses and individuals in Malaysia. This is the key of financial highlight. Begins with revenue, earning before interest tax, profit before tax, cash and banks balance, total assets, total liability, and total equity for the financial year end 2018, 2019, and 2020. Next, we begin with my part, that is current ratio under the liquidity ratio. So current ratio formulated with the current asset divided by current liability. As we can see, for the year end 2018, it shows 0.58 times. For the financial year end 2019, shows that 0.53 times, and financial year end 2020 shows that 0.6 times. It is a measure of a company for its ability to pay short-term obligation or those due within 1 year. And then, next ratio, then the quick ratio. Quick ratio formulated by current asset, the sum of current asset minus inventory minus prepaid expenses and divided by current liability. Begin with 2018 shows that 0.55 times, and 2019 0.50 times, and 2020 0.59 times. Measures that a company capacity to pay its current liability without needing to sell its current inventory or obtain additional financings. And the net working capital, NWC, formulated as current asset minus current liability, shows that negative values since 2018 to 2020. This represents the difference between a company current asset and current liability. Net working capital is a measure of a company liquidity in terms of short-term financial health. And then for the asset management ratio, inventory turnover, that is ITO. ITO formulated by cost of goods sold divided by inventory. So, begins with 2018 shows that 258.60 times, in 2019 422.67 times, 2020 shows that 1295.67 times. This is the measurement of how many times in a given period a company is able to replace the inventory that it had sold. Then I will pass to Miss Sharifah Murfiqah.
Next is average collection period, ACP. The formula is account receivable times with 360 divided by sales. For the year ended 2018, 44 days, and then increase in 2019 to 63 days, and then decrease to 2020 to 55 days. This average collection period refers to the length of time of a business needs to collect its account receivables. Okay, next is fixed asset turnover. The formula is net sale divided by net fixed asset. Uh, for the year ended 2018 is 0.54 times. 2019 is 0.48 times, and for 2020 is 0.47 times. Uh, this ratio reveals how efficient a company is at generating sales from its existing fixed asset. Next is total asset turnover, where net sales is divided by total asset. For the year ended 2018 is 0.46 times, 2019 is 0.48 times, and 2020 is 0.41 times. This ratio reveals how efficient a company is at generating sales from its existing fixed asset. Next, we have debt ratio. The formula is total liabilities divided by total asset. For the year ended 2018, 63.90%. 2019 is 68.64%, and 2020 is 67.86%. That ratio measures the amount of leverage used by a company in terms of total debt to total assets. Next, I will pass to Mr. Muhammad Raqi.
Next is leverage ratio, time interest earned. The formula is earning before interest tax divided by interest. So for a year ended 2018 is 7.09 times and decreased in a year 2019 for 4.88 times and 2020 for 0.79. It's measure of a company ability to meet its debt obligation based on its current income. So next is debt to equity ratio. The formula is total liabilities divided by total equities. So for a year ended 2018 is 1.77 times. For a year to 2019 is 2.19 times, and for a year ended 2020 is 2.11. It's measured to compare a company total liabilities to its shareholders' equity and can be used to evaluate how much leverage a company is using. Next is equity ratio. The formula is total equity divided by total asset. So for a year ended 2018 is 36.10%, and for a year 2019 it decreased to 31.36%, and for a year 2020 32.14%. It's measured to the amount of asset that are financed by owner, investment by comparing the total equity in the company to the total asset. Next is operating profit margin. The formula is earning before interest tax divided by total sale. So for a year 2018 is 30%, for a year 2019 is 27.85%, and for a year 2020 is 26.11%. It measures how much profit a company makes on a dollar of sale after paying for variable cost of production, such as wages and raw materials, but before paying interest or tax. So I pass up to Mr. Jamili. Adha.
Okay, for next under profitability ratio, is net profit margin. It calculates by earning after tax divided by total sales. So for the year ended 2018 is 19.36%. For 2019, it decreased to 16.24%. And for 2020, also the increase to 15.41%. It shows that it measure how much the net income or profit is generated as a percentage of revenues. Next is return on asset. Return on assets calculate by earning after tax divided by total asset. For the year ended 2018, is is 8.99%, 2019 6.77%, and 2020 is 6.3%. It's referred to a financial ratio that indicates how profitable a company is in relation to its total asset. So the next one is gross profit margin. Gross profit margin calculate by gross profit divided by total sales. So for the year 2018, it shows 54.98%. For 2019, 54.17%. And for the year ended 2020 is 56.65%. This ratios shows a metric analysis used to assess a company financial health by calculating the amount of the money left over from the product sales after subtracting the cost of the goods sold. The next one is return on equity. Return on equity calculate by earning after tax divided by total equity. For the year ended 2018, 24.90%. For the year ended 2019, 21.60%. 2020, 19.60%. It's measure financial performance calculated by dividing net income by shareholders' equity.
For the conclusion, based on all the calculations, graphs and comments for 3 consecutive years, here are some highlights that we can see in Maxis Berhad. Begins with liquidity ratio, where this company obviously in low liquidity and not suitable to make short-term commitment as to sustain their daily and monthly operations. Next, in this company, the asset management ratio shown that good condition in inventory turnover and the average collection period performance, while bad result for fixed asset turnover and total asset turnover. Then, in leverage ratio, shown that this company is in a bad position in view of creditor due to the high risk investment and the uncertainties can happen. And lastly, for profitability ratio, averagely shown that this company is running in bad condition and not favoritized by creditor and also investor.
So that's all from us. Thank you very much.